Installment of our video series on credit and credit scoring. My name is Kurt Jackson. I'm a certified mortgage planner in Liberty, Missouri. I'm a 17-plus year veteran of the mortgage industry. And this segment is going to talk about and hopefully give you some examples of the financial impact of not having your credit scores maximized as it pertains to housing. But before we continue, I want to give you our disclaimer. We're not attorneys. This is not to be construed, what we're doing here is not to be construed as legal advice. The information that we're giving in this video series is really just designed to help to alert you to the different things that surround your credit report, and that if you found that there was a reason to contest it, you could consult with an attorney or someone that obviously knows the legalese inside and out. What we're going to talk about today is for one, is the first significant difference in credit scores is that for you to qualify for the best rates available from the Federal National Mortgage Association, otherwise known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, otherwise known as Freddie Mac. You've probably heard about those folks on the news. These are the two largest purchasers of mortgages in America. And what that means, folks, is that most of the time it's not like your mom and dad or grandparents did when they went and got a loan. They went to the bank, and the bank lent their own money out, and that money was from, savings accounts, CDs, whatever, the depositors. What's happening now is your mortgage is packaged together with thousands of other mortgages, and they are sold off in big blocks to investors on Wall Street. So the bank may service the loan, that means they take the payments, but they're passing those payments on to the investors on Wall Street. So it's a totally different animal now. Those two are kind of quasi-government agencies that are not necessarily backed by the government, but they are. So what it means is that these are designed to make sure we always had liquidity, meaning there was enough money to lend, and that the rates were very competitive when we get money from Wall Street. Well, what's happened is that in order to get the best priced loans, meaning interest rate and fees from Fannie and Freddie, you need to have a 680 or above credit score. Now, it used to be lower than that. In fact, Fannie doesn't use credit scores in their decision-making process, but they certainly do in their interest rates and what drive their fee structure, what drives interest rates. What I'm going to do now is I want to take a snapshot from the third week in January of 2008, where interest rates were on 30-year fixed with a 30-day lock. Now, this is not an offer to lend, since these rates are even from before when I recorded this. They're obviously not necessarily accurate for the day that you watch this video or any other day, because rates change on a daily basis, sometimes on an hourly basis. But I wanted to give you kind of a snapshot of the difference if you had applied on this date with a credit score of 680 and above, you could have qualified for a 5.75% 30-year fixed rate with no points. If you had a credit score between 660 and 679, you could have done a no-point rate at 6, which is a quarter higher, or you could have paid 3/4 of a point in order to stay at the 5.75. If you had a 640 to a 659, in order to get a no-point rate, you'd have been at 6 1/4, or to stay at 5 3/4, you would have had to pay 1.25, 1 1/4 points. A point is 1% of the loan amount. So if you had a $100,000 loan, 1 point would be $1,000. In this case, 1 1/4 points would be $1,250. If you had a credit score between 620 and 639, your no-point rate is 6.5, which is 3/4% higher than if you had a 680 or above. Or if you wanted to keep that 5 3/4, you would have had to pay 1 3/4 points. If your credit score was below 620 and you were able to qualify, the chances of you qualifying, depending on would depend on probably having a lot of equity, a lot of other strong points in your file in order to qualify. But you'd have had to get a 6.625 rate in order to have no points, or pay 2 points to keep that 5 3/4 rate. So it's obvious that there's additional costs now when your credit scores are below that 680 level. Just to give you an idea what this means to you if you have a credit score below 680, I gave some different examples that show up here on the screen, and I just wanted to highlight one for each dollar level. So this was to give you an idea of what a $100,000 loan would be with a credit score between 640 and 659. Your payment would be $32.14 a month higher, which adds $2,700 over 7 years, which is the average time a person owns a home, to $3,857 over 10 years, or you could have paid that additional $1,250 in upfront cost to keep your payment the same. Now, obviously, the bigger your loan, the bigger the difference is going to be. If you had a $150,000 loan with credit scores between 660 and 679, your payment would be $2,397 higher. That's $2,013 in additional costs in the first 7 years and $2,875 in 10 years, or an additional upfront $1,125. If you had a $200,000 mortgage and a score below 620, if you could get the loan, your payment would be $113.48 a month higher, costing you an additional $9,532 over 7 years and $1,367 over 10 years. Or you could have paid the additional $4,400 in upfront costs. On a $300,000 mortgage with a score between 620 and 639, you could get the loan. If you could get the loan, your payment would be $145.49 higher, costing you an additional $12,220 over 7 years, an additional $17,458 over 10 years, or you could have paid an additional $5,250 in upfront costs. So if you were going on a $400,000 mortgage with credit scores between 660 and 679, so think about this: you could have a 679. Your payment would be $63.91 higher than having a 680. Which costs you $5,368 more over 7 years, $7,669 over 10 years, or you could have paid an additional $3,000 in upfront costs. Now, folks, this doesn't even take into account if you finance more than 80% of the value of the house and have to pay private mortgage insurance or get a second mortgage. If you've got you're going to have additional costs on those too if your scores are below 680, and there's going to be some limits on how much you'll be able to borrow. The key for you to understand here is that getting and maintaining a high credit score is paramount to your financial success. Not just in the mortgage industry, but all over any industry that lends you money. We already talked about the insurance and employment too. So you want to keep your credit scores maximized. So much is impacted by those credit scores because the interest rates on your credit cards and auto loans are going to be dictated by your credit score. When it comes to homeowners insurance and car insurance, many companies are now using credit scores to determine your rates, or if you're qualified to use them at all. They think that if you have lower credit scores, you're under financial duress and you're more likely to have an accident or do something to your house. So they're going to charge you more if they'll insure you at all. And don't forget, many employers check your credit scores during the hiring process. With this importance, folks, in our business, we felt an ethical responsibility to share this information with as many people as possible. So if you found this information to be helpful, please tell your friends, your family, your coworkers to check out these videos. If you've lost the link, you can email us and ask us for the link. We'll be happy to send that to you or to your friends. But they need to check out these videos. If they have any questions, keep in mind you can always call us, email us at the address listed on the screen. This is just a quick snapshot of how much your costs can go up because your credit score isn't as high as it could be. There's many other facets and factors that can come up depending on your particular situation, and there's too many to try to cover in the limited amount of time that we have here in this video series. So keep this in mind, and if you have any questions, you can contact us at the information that's on the screen. Thank you for viewing this segment of our credit scoring seminar. Please make sure you tune into the next segment. If you got any questions or comments on this segment, please email us at the email address on the list on the screen, or you can call us at those numbers too. Thanks for tuning in.